I think that we can start. First of all, thank you very much, Alberto, for having accepted to be with us today to deliver this lecture. This is very much appreciated. I indeed value a lot the effort that you and other academics are doing to be with us. I know that time is always the most binding constraint in our lives. So it is a great pleasure and I think a privilege that you can give some time of your daily business to discuss these topics with us, to be part of this idea of the ECLAC school, which I think is I think we share the same love for this enterprise, for this school, and for ECLAC. So thank you very much. And let me just tell you that we have 29 students from many parts of the world, some from Italy, and we have also a student from Vietnam, which is, I would say that we every year have some students from Asia. But basically, we had Japanese and Korean students. From Vietnam is the first time that we have a student participating of this. So, well, you are very most welcome, and please, Alberto, the floor is yours.
Okay, thank you. Well, first of all, thanks, Gabriel, for inviting me. I have to say that it's always a pleasure participating to the summer school because I am an alumni of the summer school. I attended it this year 17 years ago because it was 2004. I think it was the 4th edition of the summer school or 3rd edition of the summer school. And I spent 6 months actually in Santiago at that time, and it was a great pleasure. It was a great experience. It was part of my PhD, and therefore it is a pleasure for me continuing to contribute to the summer school this time as a professor, let's say. So. Before starting, I just would like to tell you that since that there was someone typing in the chat, I'm not very well with English. It's a long time I do not speak in Spanish, so I will give my presentation in English. But feel free to reply or to make any question in Spanish. In the sense that I perfectly understand Spanish, there is not any problem. My fluency in Spanish is not that good. That's why I prefer to talk in English. But there's not any problem if you'd like to intervene and make question in Spanish. Feel comfortable with that. There's no problem. And please intervene as much as you can. If there is any doubt, if there is any question, or you would like to deepen a little bit the discussion about any point of my presentation, feel free to intervene, to interrupt me, right? Or alternatively, if there's something unclear, feel free to stop me and ask for more explanation, right? So I'm not very familiar with the software, so I told this is the 3rd or 4th software I downloaded on my laptop in this year in order to have online meetings. So I kind of move from Skype, Zoom, Teams, and now Cisco WebEx. So let's try to share my presentation, and let me see if you can see it.
It's working.
Okay, so
we are seeing your computer now.
Okay, so here is my presentation. I guess you could see it, right? Is it okay?
It's okay.
Great.
We can see it
perfectly. Perfect. So I don't know also if you had a chance to watch the brief video I sent you more or less 1 week ago or something like this. That was a video in which I tried to explain some technical mechanism of the balance of payment. That video might be useful in order to, in preparation to what I will go through in this through this lecture, because in this lecture I would like to discuss a little bit some mechanism of open economies, starting from the national accounting of an open economy, then go through a kind of prototype balance of payment cycle, and then moving to the formal part of this presentation, trying to describe a little bit some features of a model I built up myself, trying to combine balance of payment cycles and the Dutch disease, or more broadly, the natural resource cures. This will be the fourth part of how to say, our time together, because then next lecture tomorrow, but we can even deepen our analysis this afternoon with during the tutorial. I would like to try to find a better connection between natural resource cures, that Dutch disease, a specific form of the natural resource cures, financial flows, and if you want, financial speculations, and the dynamics of the productive structure in developing countries. This is more or less is an overview of what I would like to do. Feel free again to intervene. Don't be shy and stop me whenever you want, if you want to make me a question. So let's move on. This is more or less the outline of the presentation, of today's presentation. First of all, I would like to make a brief recap of the national accounting of an open economy. Very simple, actually, accounting identities. Then there is an economic theory building up on these identities, but we will start with some identities of open economic system. We will consider two different interpretations from that identities, in the sense that we will analyze a, let's say, mainstream interpretation of the results of the connection between magnitudes and variables, including that identity, and an heterodox interpretation of that same equation. So giving you an idea that different economic theories may have different perspectives about the same topic and the same object. Then I will move to an analysis of given a given interpretation, given a certain interpretation of the national identities we will go through in a short while. I would like to discuss with you which reforms were implemented in many developing countries, in particular Latin American economies, under the so-called Washington Consensus, and the effects of those reforms on the stability of developing countries, Latin American economies among them. And then, as I told you, I would like to move to the formal part of my analysis, a description of a model in which I try to combine the Dutch disease as a specific form of natural resource cures with financialization, drawing some policy implication from the results of that analysis. Right? In this presentation, there will be a bit about the effects of Dutch disease and financialization over the productive structure of developing countries. This analysis is kind of implicit, in the sense that there is not any formal equation trying to describe and trying to make a clearer connection between the Dutch disease, financialization, and the dynamics in the productive structure of developing countries. This is something I would like to develop a little bit further next lecture tomorrow, or if you have time, and if you want, in the afternoon during the tutorial time. Everything clear so far?
Yes.
Perfect. Okay, let's start. So this is the starting point of my analysis. Again, this is a very simple accounting of an open economic system, because in the first line, you have the definition of GDP in an open economy. As you can see, GDP is given by nothing else, summing up private consumption, C, public purchases, G, investment, I, plus export minus inputs. These are the demand components of the domestic generation of income. If you want, this is the disaggregation according to different demand components of the sources of domestic income. I say domestic income because if we move to the second line, I had to this identity foreign sources of income. Because when we are talking about an open economy, we don't have only export and imports, but we also have international transfers of resources that then can enlarge or reduce or squeeze total disposable income. In particular, what we have, as you can see, first of all, the mathematical consistency of this identity doesn't change because I had NR and NIP on one side and also on the other side. So the mathematical consistency is still there. What these two terms mean? NR stands for net remittances. These are the flow of resources that could move from one country to the other, given to the repatriation of part of the wage income, for instance. A very stupid example. My formal job is in the UK. I get a wage from my own university, the University of Greenwich in the UK. If I send back part of my wage to my dad still living in Italy, this will be a net remittance, a positive net remittance from the point of view of the Italian economic system, because the Italian economy will receive a net positive transfer of resources from the UK to Italy, right? Well, this could be the same happens for the many immigrants, for instance, living in the US and sending back part of the payments to Mexico, for instance, or any other country they come from. So net remittances, in some cases, are relevant sources, external sources of income for the recipient economies, right? And this is a net magnitude in the sense that it could be positive or negative. For some countries, it's positive in the sense that they receive net positive inflows of remittances. In other cases, it is negative in the sense that if you take again the case of the UK, after the huge increase in immigration to the UK of other European citizens, very likely in the UK there is a negative net remittance in the sense that people living and working in the UK would give rise to outflow of resources with respect to what UK citizens working abroad are doing. Okay. The other component, NIP, stands for net interest payments, or I could even have written net factor payments, because basically these are financial transfers. These are financial transfers taking place among countries if, for instance, an international financial institution bought peso bonus, right? Let's assume in a very simple way, in order to frame this discussion in the context of Latin American economies, let's assume that Morgan Stanley or Goldman Sachs purchased in the past some peso bonus issued by the Argentinian government. The Argentinian government has to pay every month or every 3 months or every 6 months some interest. These interests are net interest payments, negative from the point of view of the Argentinian economy and positive from the point of view of the US economy in this case, since that we are talking a financial investment undertaken by a US economic actor, Morgan Stanley or Goldman Sachs. Any foreign direct investment in a foreign economy, I don't know, US companies investing in the copper sector in the Chilean economy and repatriating some of their profits in the home country, this is again a form of net interest payments. We are not talking about interest in the stricter sense of the term. We are talking about factor payments, better to say. Still, we have an outflow of resources from the Chilean economy towards the US economy. In this case, we would have a net negative entry in the case of the Chilean economy and a net positive entry in the case of the US economy. In any case, net interest payments are financial transfers occurring from previously accumulated financial position, from previously accumulated financial assets. Okay? And of course, again, these two external sources of income, net remittances and net interest payments, sum up to the domestic sources of income, GDP, in order to provide us with the total income available to economic actors in a given economy. Right? Third step, when we move to the third line, I just introduced taxation, the amount of taxes. So that from in line 2, I defined total income. In line 3, I determine total disposable income, because simply I subtract taxes from the entries any households, any economic institution might have in a given period, right? So if you take Y plus net remittances plus net interest payments minus the amount of taxes that economic actor has to pay, we get the total disposable income. The total income from domestic and external sources of income minus taxes that economic actor, it could be an household, or it could be a company, it could be a corporation, have to pay. Right? That's why here in the fourth line, we have the disposable income here. And on the other side, very simply, we have consumption, private consumption here. If we regroup a little bit, here you have T minus G, putting a minus sign outside parentheses. Here we have, in a very simple way, the public savings, because these are tax revenues minus government purchases. So T minus G is nothing else, public savings. Here I decompose investments between investment undertaken by the public sector. IPUB stands for investment implemented and undertaken by the government, and IPRIV stands for the investment undertaken by the private sector. And then here, CA stands for the current account, stands for the current account balance, because exports minus imports plus net remittances plus net interest payments is nothing else the current account of a given economic system. Right? So please feel free to stop me if you get lost in this presentation. So that bringing C on the other side, you have disposable income minus consumption is equal to the minus sign here to public savings plus public investments plus private investment plus the current account of a given economy, in a very simple way. If you just recognize that here disposable income minus consumption is nothing else private savings, and you regroup things a bit, you play a little bit around with this identity, you will find this final identity, which is not an equation. This is an identity because this is always true for any economic system. You see that if you want, the difference between public savings and public investments, so this is the balance of the public sector, minus private savings, plus private savings minus private investments is nothing else than the current account of an open economy, right? This is nothing else than the disaggregation of the very standard national identity of an open economy in which savings minus investments must be equal to the current account balance. Probably you have been already used to say that if in an open economy savings are higher than investments, then you will have a current account surplus. If savings are lower than investments, you will have a current account deficit. This is precisely what I'm telling you. What I'm adding to that narrative is just the disaggregation between the public sector and the private sector. So here you have the public sector balance and the private sector balance. Nothing more than that. In a very simple way, right? However, this identity, which always holds true for all the countries, is very important because this opens us the door for discussing the economic mechanism connecting, if you want, public spending, the fiscal balance, and the external account, and the external balance, okay? Which are the sources, if you want, of current account surpluses or current account deficit, since that they represented traditionally a big problem for developing countries. And this is part, the discussion about the sustainability of the external balance is a relevant part of all heterodox models trying to describe the external constraint for developing countries. I don't know if you already had a chance to go through the standard third-world models. Third-world models basically are putting at the center of their analysis exactly this problem, the sustainability of the external account. That's why, in a way, the standard third-world models assume that the trade account is in equilibrium, or they try to define the growth rate of the economy consistent with the equilibrium of the trade account. Because simply they are saying for developing countries, having a trade account, or better to say, a current account in equilibrium, over the long run is a fundamental requirement. They cannot escape from this condition. This is not a long-run analysis. This is an analysis in which it is possible for the current account to be in deficit or in surplus at some point, okay? What I'm simply saying is that through this identity, we could define which might be the sources of current account deficit and surpluses, and also if this current account deficit or surplus is sustainable or not over a given time horizon, right? I don't see the chat if any one of you wants to make a question, but I think I can hear you. So if you want to make me any question, feel free to talk and interrupt me, right? Is it everything clear so far?
Yes, it is. Thank you.
Perfect. Perfect.
There are no comments in the chat, so it seems that all is going well. Thank you.
Okay. No, I thought that perhaps there were already bad words like well, let's see when we come to the more formal part of the story if I get insulted start to get insulted from people. But anyway, let's move on. So this is the a national identity, which is true by default, I would say. What is relevant is that the economic interpretation built upon this macroeconomic identity. And this is exactly what I would like to do. I want to take another step further, because there is that identity plus the identity characterizing the functioning of the balance of payment. Because here you have what I wrote in the previous slide, the balance of the public sector, the saving balance of the public sector, the saving balance of the private sector. Summing them up, we get the a current account deficit or a current account surplus. And here you have the standard equation representing the evolution of the balance of payment. As you know, this is another identity. The current account plus the financial account minus the variation in foreign reserves must always be equal to zero. There's no way out of this. So this is an accounting identity. Then we could discuss about the mechanism between these three different components of the balance of payment, right? But this is true by default. What is relevant is talking about the determinants, the economic determinants of these variables. And here we have the point I would like to discuss with you. If we return to the saving gap, let's say, the saving gap in the public sector, the saving gap in the private sector, and how this determines the current account deficit and surplus, obviously, from the point of view of developing countries, and many policy recipes suggested by international organizations are about the so-called domestic absorption. How much an economy is spending. How high is the domestic demand, if a given amount of domestic demand is sustainable in terms of the external balance. Again, we return back to the standard third world model. The standard third world model simply told you the economy, a given economic system, must grow at this given rate. A given economy must expand at this growth rate, given income and export income elasticities and income variation of the real exchange rate, in order to maintain the trade balance in equilibrium. Okay. Here we are moving a little bit far away from this condition because there's not an equilibrium condition here. What we have is that through this national accounting, we could say which is the current account surplus or deficit corresponding to a given domestic demand level. If the level of domestic demand in that economy is too high, if the domestic absorption is too high, in order to ensure a current account in equilibrium or a surplus, and in turn it leads to a deficit. Okay. When talking about fiscal austerity, most of the time suggested by the International Monetary Fund, by international organization, when developing countries went through external account crisis, external balance crisis, the justification for those policies came precisely for the interpretation of this equation, of this identity, better to say. Because most of the time the IMF told developing countries, governments in developing countries, look, there is a too high demand in that economy. That level of domestic demand is not compatible with the external equilibrium, is not compatible with a safe current account surplus or an equilibrium. You need to cut the domestic demand. You need to reduce domestic absorption. Hence the need for implementing austerity measures. Austerity measures that could be taxes increased in order to reduce private expenditures, but also to improve the public fiscal balance. So this is the standard interpretation. Okay. This is relevant because when we move to point 2, the general ideas, at least before the 1980s, at least before the outbreak of the first debt crisis, of the first external debt crisis in developing countries, keep in mind that there was the idea that the current account deficit caused fiscal surpluses. Fiscal surpluses, financial account surpluses. And financial account surpluses, if you watch the video I sent you, is nothing else increasing accumulation of external liabilities. Financial account surpluses most of the time are associated to mounting external liabilities, so mounting external debt. Then we have to discuss when this external debt is sustainable or not. But in any case, the standard interpretation before the first debt crisis in developing countries was these developing countries are consuming too much, are better to say are spending too much. It could be even high investments. Developing countries are spending too much. The level of domestic demand is not compatible with a safe current account position, either in equilibrium or in surplus. Too high domestic spending is giving rise to a current account deficit, and in turn, these current account deficits are leading to financial account surpluses, are leading to increasing external indebtedness. In the end, this external indebtedness couldn't be sustainable, as the external debt crisis hitting many developing countries at the beginning of the 80s. Okay, and the debt restructuring imposed to developing countries, Latin American economies among them. Probably you already heard about the Brady Plan, which was implemented in the 80s in order to favor the reduction of external debt in Latin American economies, Mexico in particular, for instance. I don't remember if the Brady Plan was applied also to Argentina and Brazil. For sure, it was applied to Mexico. But the interpretation was, let's move to point 3, the standard orthodox interpretation. Too much, in particular, too much public imbalances and too much fiscal deficit caused external imbalances. That's why the so-called twin deficit. A deficit in the fiscal account is at the roots of the deficit in the external account. Means the public sector spending too much, being the source of external disequilibria, external imbalances. If you want to adopt a safer macroeconomic position, if you want to adopt a safer macroeconomic stance, you have to squeeze the fiscal deficit, hopefully even run a fiscal surplus, and this will help you to reduce the a current account deficit or even move to a current account surplus, which will imply reducing the external liabilities and therefore the amount of the external debt. Right? In some papers, there has been an heterodox reply to that position, suggesting, look, it's not true that it is the public sector the primary responsible for these imbalances, but most of the time are dynamics taking place in the private sector. And most of the time are dynamics originated from financial mechanism, from financial dynamics, from financial reforms, from liberalization measures, for instance, of the financial account. But in any case, the responsible for those disequilibria is not in the public sector, but rather in the private sector, and how the private sector reacted to some reforms implemented in developing countries, in particular, liberalization of financial transactions. And also, if you want, trade transaction and trade relationship. Right? So, here it is. So, given the prevailing interpretation of that national identity at the beginning of the 80s, these are 4 reforms implemented in most developing countries, Latin American economies among them, has to the monetary financial side of the story. Now, I'm not talking about structural reforms related to trade openness, but they are in a way related. These are the complementary reforms with respect to reforms targeting trade relationship and trade openness. If you want, these are reforms related to financial openness and related to the regulation of the financial sector. Okay. So the first point is about financial liberalization, which means removing all the capital controls existing in a given economy, removing all the impediments that in the past could impede capitals to move freely in and out the economic system. Okay, or perhaps restriction to the behavior of domestic financial actors. The story is that in the 60s and 70s, many developing countries, but not only developing countries, also developed countries, implemented some forms of financial restrictions. In the case of Italy, for instance, the public sector forced financial institutions to accept some ceilings on interest rate. Financial institutions were impeded to charge interest rates higher than a given ceiling. This happened also to in developing countries. Or alternatively, many financial institutions in Italy were forced to allocate their funds, allocate collected funds to some specific forms of investment. So financial institutions were not free in giving rise to their own allocation of funds at the interest rate they wanted, or interest rates determined through market mechanism. There were some restrictions imposed to financial institutions. And this was possible because at that time, many financial institutions were under the umbrella of the public sector. So there was a much larger state control of financial institutions with respect to what is going on right now. From the point of view of neoliberal economists at that time, these ceilings caused a reduction in savings and a reduction of investments. Why? Because neoliberal economists and mainstream economists are used to thinking in a pretty standard way. Savings determine investments. So savings come first, and how the more savings we have, the more investment we will have inside the economic system, right? If you put interest rate ceilings, if you squeeze the degree of freedom of financial operators, and if you if you reduce the interest rate that could accrue to domestic savers, you will induce a forced reduction in savings, in available savings, and therefore you will cause a reduction in investments. A reduction in investment in the end will negatively affect the growth rate of the economy, will reduce capital accumulation and the growth rate of the economy. Many neoliberal economists at that time said that financial controls and financial regulation was meant to make fiscal dominance possible. Why? Because if you forced domestic financial institution to set interest rate up to a certain limit, this was meant to provide the public sector with cheap credit. You can charge, let's say, let's do a concrete example. Governments in the 60s told financial institutions, which were mostly controlled by the public sector itself, you can charge interest rate on loans up to 3%, no higher than that. This is an example of an interest rate ceiling. In that case, the public sector could get financed by financial institutions at the highest interest rate payable by public institution was 3%, because this was the ceiling introduced by law. There was not the possibility that financial institutions charged a higher interest rate if they thought that the public sector was unreliable and it could go bankruptcy. So in a way, those financial controls and those financial restrictions in the mind of neoliberal economists were introduced in order to allow the so-called fiscal dominance, in order to allow the public sector to spend as much as it wanted, removing all those restrictions, removing all those controls, were meant to introduce a kind of market-driven discipline in order to tell the government, look, you can't do any longer what you want. You need to be responsible. You need to reduce public expenditures if they are too high, if they are not consistent with the fiscal, a balanced fiscal budget, because otherwise markets will punish you. If financial operators will think, very likely you will go bankruptcy. If financial markets think that your financial position is unsustainable over the short or medium run, then they will punish you asking a higher interest rate in order to buy your liabilities, in order to buy on financial markets your promises to pay in the future, because they don't think any longer you are trustworthy, right? So the idea of introducing financial liberalization, the idea of removing all financial controls and all financial restrictions, was implicitly a way to move away from the so-called fiscal dominance, a public sector capable to spend, in a very rude way, a lot of money, okay, and introducing a kind of market-driven discipline, the so-called bonds vigilantes. Financial operators have to purchase, are those one giving you loans implicitly by buying public bonds. If they think that those public bonds will lose value because the public sector is not reliable, it is not trustworthy, then they will ask for high interest rate in order to compensate them for the higher risks they will take on board by purchasing bonds issued by unreliable governments, right? This is a kind of establishing a market-driven discipline, because then, as a reaction, government could decide to, take more conservative fiscal policy stances, reduce expenditures, cut the provision of some social services, for instance, implement reforms in the pension system, reduce public investments, or alternatively, increase taxation. Right? In a very simple way. Connected to this point is the second reform, most of the time implemented in many developing countries, but not only, also developed countries. The introduction of independent central banks. Till the beginning of the 80s, many central banks were tightly connected with the treasury, and in a way, central banks were forced by law to give support to expenditures undertaken by national treasuries. This was the case of Italy, again. Keep in mind that in 1881 is the year of the so-called divorce of the Bank of Italy with respect to the Italian treasury. Okay? Before, the Bank of Italy was forced to purchase on financial markets, all Italian government bonds remained unsold. And this was obviously a legal obligation of the central bank, which helped to keep interest rates on government bonds low and make a kind of expansionary fiscal policy stance more sustainable. This kind of obligation for the Italian central bank was removed in 1981. There was the idea of introducing a more independent central bank, as now happens also in many developing countries. The reason is that now independent central bank should just look at controlling inflation without paying attention to the sustainability of fiscal policy. The government should take full responsibility for that. If fiscal policy stance is not sustainable because the government is spending too much, then financial markets will punish this behavior by asking higher interest rate or by cutting liquidity provided to national governments, and perhaps cause the default of those governments, which turn out to be unwise. Right? Point 2 was also connected to point 3, because on top of re-established a kind of wise behavior by the domestic government, introducing an independent central bank was also meant to reduce inflation. Inflation in the 80s was an important issue also in developed countries. Not all developed countries, but keep in mind that inflation in the US at the beginning of the 80s was above 10%. I think it was around 12%, more or less, 12, 13% at the beginning of the 80s when there has been the Walker shock taking place. In the case of Italy, again, inflation was higher. In some years, I think 1981 was higher than 20%, which is not an enormously high inflation rate, but definitively much higher than what we are used right now, because now inflation rates are in the range of 2-3%, 4% maximum, much lower than what we were used to in the 70s and beginning of the 80s. Not to talk about developing countries. I mean, in Brazil, in Argentina, in Bolivia, in Peru, there were examples of hyperinflations. In Argentina, if I remember well, and Brazil, at the beginning of the 90s, inflation was about 1,000%. In Bolivia, it was even above 5,000%, if I remember well. So these were cases of inflation completely out of control. There was the idea that in order to put inflation under control, you need to introduce trustworthy, credible monetary institution, hence an independent central bank not providing cheap money any longer to the government. And one way to control inflation was the introduction of a fixed exchange rate regime. Interestingly, this policy advice, point 3, was never explicitly included in the Washington Consensus package. Because if you read some description how the Washington Consensus has Williamson originally presented it, there was not a clear indication of any exchange rate policy. And you know that in general, we are used to associate the Washington Consensus with neoliberal policy packages, and Milton Friedman traditionally was a supporter of flexible exchange rates, right? So there's not a clear indication about which kind of exchange rate policy, of exchange rate regime to be implemented in developing countries. It is true, however, that in the 70s and in the 90s, many developing countries decided to adopt a fixed exchange rate regime because this was thought as an effective way in order to introduce credible expectation about the reduction of inflation. And we have to admit that, for instance, in the case of Argentina, it worked pretty well in terms of reducing inflation expectation. In a few years, inflation rates in Argentina decreased from above 1,000% to in the range of 50 or even lower rates. So this idea of introducing a fixed exchange rate a fixed exchange rate regime, in order to convince people that inflation would have decreased in the future, it was a kind of effective. Now it is a point if this is a sustainable policy choice. This is something we will discuss later on. But it was clearly a decision aimed to convince people that domestic monetary institutions and domestic governments were tightly committed to reduce inflation, in some cases hyperinflation, right? The final point is consistent with all the others, because in order to introduce a market-driven discipline, you need to create a market. In order to create a market, a financial market, you need to privatize all the financial institutions which previously were under the umbrella of the public sector, because otherwise you can't really have a kind of interaction between the private sector and the public sector. If all the institutions were under the public umbrella, were controlled by the state or by public institution, there was not really a possibility for putting a kind of external eye controlling the behavior of the public sector. That's why the need of privatizing most banks on top of non-financial companies. Okay? Through all these reforms, what happened is that from the point of view of external investors, developing countries and Latin American countries in particular became very promising investment opportunities. The formal mechanism through which this happened is through the so-called uncovered interest parity. This is an equation which may help us to understand why and when it is profitable and convenient and more remunerative, let's say, from the point of view of international financial institutions, investing in developing countries rather than in developed economies, right? May I ask you how many of you have already seen the uncovered interest parity? Is it something you are familiar with?
No.
I never see it.
Okay, good. Okay, so that I understand if I have to explain it. Anyway, so the uncovered interest parity, UIP, is a condition telling us when, from the point of view of international investors, take again the point of view, the perspective of Goldman Sachs or Morgan Stanley, it is more remunerative to invest in developing countries by perhaps purchasing a Mexican government bond, or put their money in a safer US government bond. So here you have two options. If you take the point of view of an international investor, you have two options. Should I invest and put my money in developing countries by purchasing a Mexican government bond, or should I invest in a US government bond? Now I'm using public bonds for the sake of analysis, but I could even talk about corporate bonds issued by private private companies, it doesn't matter. It is just a matter to understanding the kind of rationale behind this allocation decision in terms of international funds, right? And here there are three components you have to take into account in order to take your own decision, whether to invest in Mexico or whether to keep your money in the US. Okay. First of all, let's assume that we take the perspective of the Mexican government, or it could be the Argentinian government, of the Brazilian government, and we're asking ourselves, which is the interest rate I have to pay to foreign investors in order to attract international funds, in order to attract international investors, and convince international investors to invest in the home economy, to give me money, to give me their funds, right? Now, let's assume I'm the Mexican government. So H stands for the home economy, and the home economy is Mexico. And I'm trying to put myself in place in the feet of the Mexican government and thinking which is the interest rate I have to pay on the government bonds I'm issuing on financial markets in order to attract foreign investors. Is it clear to everybody, this point so far? Perfect. Guys, feel free to intervene if something is not clear, right? Perhaps I'm running too much or perhaps I'm too slow. Just give me feedbacks, because otherwise it's hard to me to understand if I'm doing well or not, and if, more importantly, if you are understanding or not. So I'm the Mexican government. I have to decide how the interest rate I have to pay to foreign investors in order to attract foreign capitals. And the starting point, obviously, is the interest rate set on international financial markets. If, for instance, the US government is paying 5% interest rate on US government bonds, obviously, the Mexican government, in order to attract foreign investors, has to pay at least minimum level 5%. Otherwise, there is no meaning of attracting, there's no way of attracting foreign investors. If the US government is paying 5% interest rates on US government bonds, and I will pay 4% interest rate on my own bonds, there's no way of attracting foreign investors. It means that in order to attract foreign investors, I have to pay interest rate at least as high as those paid by the US government bond, by the US government, right? So at least 5%. This is not enough. Why this is not enough? Because the US government bond is denominated in dollars. The Mexican government bond is denominated in pesos, two different currencies. And international investors will pay attention whether a currency will appreciate or depreciate with respect to the other. If Goldman Sachs wants to put their money, is considering to invest in Mexico, but the Mexican pesos will lose value with respect to the US dollar, this will represent a capital loss from the point of view of international investors. Because at the end of the investment, when that asset will come to maturity, will expire, you will get back Mexican pesos, which in the meanwhile lost values with respect to the dollar, right? So on top of thinking about interest rates, international investors will try to think about the relative dynamics of the two different currencies. Because if I invest in and then purchase Mexican government bonds, I will get a remuneration in Mexican pesos. If I invest in a US government bond, I will get a remuneration in US dollars. If Mexican pesos, in the meanwhile, lose value with respect to the US dollar, obviously I will suffer a capital loss. I will get a lower remuneration than what I could receive by investing in US dollar. Why this is important? Because this second term is nothing else the expected depreciation of the Mexican pesos with respect to the US dollar. If I'm expecting in the meanwhile that Mexican pesos will lose 5% value with respect to US dollar, then international investor will ask the Mexican government to pay at least 10% interest rate rather than just 5% interest rate. Because on top of giving as much as the US government is paying, they would like to be compensated for the expected loss in terms of a depreciated currency with respect to what they would get by investing in US dollar. So it's like 5% interest rate plus an additional 5% interest, a 5% remuneration, compensating international investors for the expected loss in terms of depreciated domestic currency. Right? And the final point, the final element is sigma, which is the so-called country factor risk. There's the idea that Mexico, developing countries more broadly, are less reliable than developed ones due to political instability, due to economic instability. The case of Italy is emblematic, the so-called spread between the Italian government bonds and the German bonds. The basic idea is that financial markets believe that Italy is less reliable than Germany, okay? And therefore, for international investors say, okay, you want my money, you want my resources, okay, pay me a spread. Pay me an extra remuneration because otherwise I don't want to take on board that risk. Okay? If you sum up all these things, and these give us the interest rate that the Mexican government has to pay to international investors in order to attract their funds. When this condition holds with equal sign, it means that international investors are absolutely indifferent in putting their money on US government bonds or alternatively on Mexican government bond. If there is a major sign, it means that very likely international investors would like to give rise to capital inflows towards developing countries. And this is precisely what happened in the 90s, when many of those financial reforms were introduced in Latin American economies, because what happened is that if we adopt a fixed exchange rate regime, and that fixed exchange rate regime is credible, is thought to be reliable by the point of view of international investors, the risk of an exchange rate devaluation disappears. Okay, here we eliminate this expected depreciation of the domestic currency. This is exactly what happened in Argentina. When Argentina, at the beginning of the 90s, adopted the so-called currency board, which was a fixed exchange rate regime 1-to-1 with the dollar, a peg with the dollar, it means that the message sold to financial investors is that we will be much more reliable in terms of fighting against inflation, and basically we will eliminate all the risk of an exchange rate devaluation if this exchange rate regime is believed to be credible, right? If financial operators, financial investors think that this exchange rate regime is credible, then this element will disappear, okay? And therefore it might happen that at least for a short while, domestic interest rates will be higher than the international one, and from the point of view of international investors, will become more profitable and more remunerative to invest in developing countries rather than in developed ones. And on top of this, there's a change in sigma. By adopting those neoliberal reforms I told you before, many developing countries appeared at the time as more interesting investment opportunities than developed countries, because there was a reduction, a perceived reduction. I'm not saying it was real, but there was at least a perceived reduction in the country factor risk. Okay, with interest rates set originally higher than the, let's say, the right-hand side of this equation, from the point of view of international investors, became much more attractive to put their money in developing countries rather than keep those money in developed ones. Right? is clear more or less the rationale. And in fact, these are the results. If we focus on portfolio inflows, which are the most volatile type of capital flows among countries, because these are investments in bonds, equities, and whatever it is, you can clearly see the huge increase in portfolio inflows towards Latin American economies at the beginning of the 90s, end of the 80s, beginning of the 90s. Okay. Here, if you focus, you see an initial increase in portfolio inflows towards Latin American economies in the second half of the 70s. These are the so-called Petrodollars. These were mainly bank loans towards Latin American countries because American banks were full of dollars stored in US bank accounts by Arab countries. Arab countries, you know that in the second half of the 70s, there were two oil shocks with the price of oil increasing massively. It means that Arab countries reaped a huge amount of dollars by exporting oil at much higher prices. Rather than investing in their own economies, most of the Arab countries stored those dollars in US banks account, and US banks recycled those dollars investing in Latin American countries. Okay, this was before the outbreak of the first debt crisis in Latin American countries. And there is the first part. When we move towards the end of the 80s, beginning of the 90s, we see that those initial inflows are nothing with respect to the huge increase in capitals entering Latin American economies after those reforms were implemented, and after Latin American economies were perceived much safer after the implementation of those IMF World Bank suggested reforms. Okay. The point is that obviously you can clearly see that these capitals are highly unstable because you have up and down happen. Massive inflows followed, if not outflows, still considerable reduction in portfolio inflow. Or you see the effects of the Argentinian crisis, right? The Argentinian crisis affecting negatively portfolio inflows because most of international financial investors removed their, tried to take their money back, okay? Then a return, a new surge in capital flows, in portfolio inflows towards Latin American countries, and then a new collapse. This collapse related to the last financial crisis, to the outbreak of the subprime crisis in the center of the world financial system, draining resources out of developing countries, and then a new surge. So here it is clear the huge increase in international capitals in and out developing countries. Right? Any question?
Alberto, there is a question. I have a question about the last term. I think is the interest parity equation.
Yeah.
The question is the last term.
Yeah. Sigma.
Is Sigma is Carolina who asked it. Carolina,
yeah.
Sigma to which you refer to?
Yes. My question is whether this sigma is given by the market or is something that is an agreement between the investor and the government.
No, it's given by the market. It is given basically by, if you want, rating agencies. Rating agencies make an assessment of countries, of the economic condition of specific countries, and therefore then market operators take their own decision in terms of assessing which is the country factor risk. Well, obviously this is influenced also by policies implemented by national governments. And very importantly, I'm not saying that those policies are correct. At least those policies are perceived to be correct from the point of view of financial operators. I'm not saying they are correct. Well, on the contrary, in many cases, they could well be wrong. The important is that what we have to realize, for the good or bad it is, now when you talk about policy decision in terms of monetary or fiscal policy, there is also the discussion, you need to be credible from the point of view of financial operators. You need to be trustworthy. You need to send a message to financial operators that those policies are reliable. This is, for instance, what happened in many Eurozone countries in 2011. They implement the tough austerity policies. We were in the end completely wrong, but just because the idea is that you need to convince financial markets, right? Or this is what happened again in Italy in 2018 when there was the first government between the five-star movement and the Italian Liga, right? There were reactions from the point of view of financial markets because, according to them, those policies that the new Italian government was planning to implement were not considered affordable and reliable. In any case, this depends mainly on sentiments and feelings of financial operators, perhaps according to ratings provided by rating agencies.
Okay, thank you.
There is another question from Juan Manuel Campana.
Yeah.
Asking if the sigma can be assimilated to the EMBI. Right? EMBI.
What is the EMBI? I don't know what it is.
I don't know either.
Well, it is not related only to the market for bonds. It is a more relevant. It is a more general assessment in this case. Obviously, the market for bond will reflect it in a way. I mean, in a very simple way, for countries adopting the same currency. So the case of the comparison between Eurozone countries, it is pretty simple. You don't have the exchange rate risk any longer because you are adopting the same currency, but the spread between the Italian bonds and the German ones, but the same could be between Spanish bonds and German bonds and so on and so forth, whatever you want. That spread is a measure of the country risk. You're adopting the same currency. You are under the umbrella of the same monetary institution. And why there should be different interest rates? Because you are assessing implicitly the specific country risk. If investing in that country could expose you to higher risk than investing in Germany, right? So this is what this country risk measure. Now, this is obviously a highly stylized equation. Okay, there is also a debate in terms of economic theory if this equation is credible or not, if this equation may help to understand the evolution of the exchange rate. These country risk may be different depending on the specific assets you take into account. Obviously, when you take into account corporate bonds, might be different than the spread you will have on government bonds. But the idea is that it should be associated to the general condition of the economic system, let's say.
Okay. There is another question that says, large capital inflows lead to some countries to default situations. Inclusive countries like Nicaragua had to adopt a HIPC program. Was the situation result of a wrong management from monetary and fiscal authorities because a lack of knowledge of how to deal with these inflows, or it was part of the non-regulation, the absence of controls that were part of Washington Pact? It's a tough one, but let me make you another another question, and you can answer the questions together. I am very impressed by the difference between capital inflows before the 90s and after the 90s. I always, as a Latin American who look at the 1980s crisis in Latin America because of the debts contracted in the 70s, the rise of the debts in the 70s. I always assumed that the 70s was a great period of capital inflows, but it doesn't seem so if one looks at the graph.
Well, one point is that this figure comes straight from ECLAC, because I think this figure is included in the paper written by Gabriel Palma. So this is the 2013 Gabriel Palma paper. It is about mania, panic, and something. Now I don't remember the title, but I could provide you with this paper. So Gabriel Palma wrote it, and Gabriel Palma took this figure from an ECLAC report in 2011. So it's actually ECLAC giving us these numbers.
We are the guilty party.
Yeah, you're the guilty part. But in any case, you're right. It is a kind of astonishing, the huge increase in financial flows. Here you have gross portfolio inflows, right? So you don't have the net value. There could be also outflow, but in any case, it is very impressive, the huge increase in the movement of financial capitals taking place since the beginning of the 90s. That's why, if you want, there's a reason for having a module about macroeconomic models and financial flows, because if you don't include financial flows in macro models, you don't get any longer most part of the story. So before, it could make sense building up models focused on trade relationship. If you don't include now financial movements and financial flows, I think that honestly, you will miss the most relevant part of the story. So you are not able any longer to explain the dynamics of developing countries. So including in models the exposure of developing countries to the so-called global financial cycles and the mobility of capital is a fundamental condition to capture some of the more recent dynamics in developing countries, because really they are highly influenced. Of course, structural factors are important, but there is a stronger connection between structural factors and the mobility of capitals. And you have to take on board this aspect in order to really understand the instability and the volatility affecting developing countries, because otherwise you will lose the biggest part of the story. That's my point of view, obviously, right? So you might disagree, of course, but from my personal point of view, this is the biggest part. Keep in mind that also these values are nominal values, so they are not as a ratio of the GDP. This could explain a little bit, but still it is an astonishing increase in terms of billions of dollars entering the Latin American economies with respect to what happened before, right? Is it okay?
Yes, perfectly okay for me. Yeah.
There was the other question about I don't remember if it was about Paraguay or
No, it's about Nicaragua, which went to a default.
okay.
So it's up to adopt a HIPC program. So the question was, is that the reflection of wrong management in Nicaragua, or lack of knowledge or how to deal with these inflows, or it was part of the non-regulation that Washington consensus?
Okay. Well, frankly speaking, I have to admit, I don't know that much about Nicaragua, if anything. So I don't know if the necessity to enter a highly in-depth country program is related to mismanagement by the public sector, or is due to non-regulation of capital flows. However, what I can tell you is this, at more general level. After measures of financial liberalization were adopted by developing countries, instability of developing countries increased massively. And this is also recognized by mainstream economists. There was a report back at the end of the 90s from Reinhardt and Kaminsky and Reinhardt, saying that after measure of financial liberalization, there was a step increase in the number of financial crises taking place in developing countries. If I remember well, they took into account 30 examples of developing countries liberalizing their financial account, and in the range of 5 years, 27 or something out of 30 episodes of financial liberalization went through episodes of current foreign exchange rate crisis, bank crisis, and financial crisis. So obviously, the liberalization of the financial account brought many developing countries more easily, giving rise to more easily problems of financial instability. So that's for sure. This is a kind of well accepted, even from the point of view of mainstream economists. Now there is a reply. Now there is a discussion between which are the sources of this huge increase in financial instability. Is it due to the lack of regulation? Is it due to a kind of bad domestic institution, or to intrinsic mechanism from the point of view of the market? From my personal point of view, is mostly needed to intrinsic behavior of market mechanism and financial operators rather than lack of regulation. Lack of regulation in the sense that I want to be more precise in this. Lack of regulation in impeding moral hazard. This is the standard point of view adopted by mainstream economists. Mainstream economists are saying, look, crisis, there is an increase in financial crisis in developing countries simply because developing countries do not impede via regulation, via good domestic institution, that more episodes of moral hazard take place, right? So it is a kind of, if mainstream economists talk about regulation, they are talking about microprudential regulation, impeding that domestic institution take on board too high risks, okay? From the point of view of the heterodoxy, or heterodox economist, is more a problem about macroprudential regulation. These are intrinsic dynamics of financial markets and how financial markets interact with the economy as a whole. So it's not really a problem of impeding some single institution to take on board too much risk and get too much indebted, okay? It is a problem of regulating the behavior of the economy as a whole and impede that too much high inflows of capitals enter the economic system and give rise to imbalances to the whole economic system. So if you want now, after accepting that financial liberalization could create problems of financial instability, then the dispute, the debate between mainstream economists on one side and heterodox economists on the other side is about, is the problem related to lack of good domestic institutions? Which type of good institution? On the one side, there is the idea of lack of microprudential regulation. So you have to set clear rules in order to regulate the behavior of single institution. On the other case, there is the idea that you have to introduce some appropriate macro policies in order to avoid the macro dynamics of the system, regardless the micro behavior of some specific economic actors lead to the destabilization of the macroeconomy. Okay, well, obviously here there is the sources of inspiration are different in the two economic paradigms. The heterodox economists, let's say post-Keynesian economists, are obviously influenced by Minsky, obviously. The idea that the macroeconomy prevailed. The mainstream economists, no, they think that it is mainly a problem at micro level. And you need to introduce better institutions mainly at micro level. It is a problem of even if you recognize that there is a problem in terms of the behavior of some economic actors, it is a problem of fixing, how to say, fixing problems in the market and the functioning of markets. But they assume that markets, financial markets among them, in general, works pretty well. Okay, it is just a matter of adopting the proper regulation, externalities, avoiding market failures, right? In the case of Nicaragua, I don't know, frankly speaking, that specific case. What I can tell you is that, first of all, there is clear evidence that macro mechanisms matter, and financial liberalization in general led many developing countries to default quite soon after episode of financial liberalization. This is something we will discuss in a short while, if not in the tutorial this afternoon. In the tutorial, I could give you the floor, and perhaps we could comment together some tables I've included in this presentation. And also keep in mind that this is a clear evidence. Developing countries are affected by a sort of what was labeled debt intolerance. So developing countries are exposed to capital flights and financial crises with level of debt which are in general much lower, significantly lower than what's recorded in developed countries. To say it more bluntly and explicitly, it's impossible for developing countries to reach level of public or external debt as many developed countries did. So for developing countries, it's impossible to even reach a threshold frequently spotted by many mainstream economists, around 90% of the public debt or external deficit. That is impossible. No way out of that. In many cases, capital flights could take place in the case of developing countries when even debt is in the range of 30–40% of domestic GDP, even lower. So the space for fiscal policy and for deficit and debt in developing countries is much lower than in developed countries. And this may explain a lot, in the sense that perhaps it is not really a mismanagement of public finances, but simply because the space you have is much lower than what developed countries are used to, right? And therefore, that's why you have to pay a lot of attention. It could be a problem of missing regulation. I do agree with that, but from my personal point of view, missing macroprudential regulation rather than microprudential regulation. Right? Now, here there are, I don't know if you had a chance to go through the paper written by Roberto Frankel and Marti Rapetti. I included in the syllabus of these lecture, because there are, let me remember, there are 3 tables included here, taken from that paper. These tables provide, from a personal point of view, a very clear explanation of a standard balance of payment cycle. And in a way, this table reproduces in the data the mechanism I included, I tried to explain in these 5 steps. I don't know how much time we have. I think we are running out of time, right? Because I'm expected to stop here, right? 1 hour and 30 minutes. Is it correct?
Yes, the class goes until 11:30. Some days we have somehow continually, but I understand that some students have commitments after this time, and I guess they would not be able to continue. So
let's do this.
Yeah, to finish in, say, 5–10 minutes most, and then come back to this point in the tutorial or later. Okay,
Yeah.
thank you.
So let's do this if you agree. Again, I don't know if you had a chance to read that paper written by Roberto Frankel and Marty Rapetti, but what we could do in the tutorial time is having an open discussion about this data, trying to comment this data, which are summarized from a theoretical point of view in the 5 steps reported in my previous slides. So what I could do, first of all, is to send you the slides so that you have the slides, and you can even see it if you have time in the meanwhile. And then we could open a floor for discussion and for discussing together those data. I mean, you could give me your impression about what those data tell you. We could try to understand whether there is a problem of twin deficit crisis or not, if the twin deficit mechanism is in there or not, if the public or the private sector is responsible for financial instability, turning back to the original identity, and if you can see a kind of connection between current account, financial account, and so on and so forth. Within the nexus of causality we spotted before in terms of current account determines the financial account, or if this is the other way around, then stressing a little bit more the importance of financial movements, right? Let's do this. First of all, I stop sharing. I need to understand how to stop the sharing of my screen.
Now it's okay. You stop sharing. You are mute now, Alberto, yeah.
Is there a way through which I can send you the slides via the chat or not? Can you hear me?
We can hear you, but I believe that there is no way that you can upload
Okay,
it. No.
perfect. So I will send the presentation to Gabriel, and then Gabriel can hand it out to you. Gabriel, you are mute.
Gabriel,
No. That's just I'm asking Alberto to copy Andrea.
To copy who? Sorry.
Andrea Guajardo.
Okay.
Copied in our communications because she's the one who is more directly in contact with the email of the students.
Yeah,
of course.
I will be uploading the presentation today, no problem.
Great. Anything else?
Professor, I have just a simple question to you.
Yeah.
Firstly, thank you very much for the presentation. And my question is about this movement of large capital inflows. If it occurs in other emerging regions as well, like East Asia, South Africa, I don't know.
No, I mean, from the tables we will analyze, it's important to understand that the problems created by huge capital inflows are not related only to developing countries, as they are usually understood. But for instance, one of the cases included in that table is South Korea. South Korea, mid of the 90s, because this is about, that table is about the East Asian financial crisis. East Asian crisis in 1997, 1998, at the point in which South Korea was already considered as a kind, if not fully developed economy, at least a upper middle income country, that's for sure. Financial instability could be a serious problem also for developed countries, this could be even the case of many European countries after the intervention. If there was not the intervention of the ECB in 2012 with this so well-known whatever it takes statement by Mario Draghi, well, very likely Italy could well be exposed to a financial crisis. So capital movements are so big right now and so massive that also upper middle income countries or even developed countries are not immune to that kind of shocks. So this is very important to take this into account. I think this is very important to take this into account. This is not related only to developing countries. Developing countries obviously are more exposed to financial crisis. I think that, I don't know how many of you are dealing with PhD thesis or want to develop PhD thesis, but I think that a very interesting topic could be how important is being in the center of the global financial system. If being part of the center of the global financial system could provide you a kind of shelter from financial turbulence. I think this is a very relevant topic. And because financial movements are everywhere and could be very important also, not only for developing countries, but also for, again, upper middle income countries or developed economies, right? So I think this is very important and to take into account this. I don't know if I replied. I don't know if this is what you would like to, if I addressed your question correctly, but again, I really think that capital movements are fundamental. If you don't take them on board, you miss a big piece of the puzzle. If you have a puzzle of 1,000 pieces, you will lose at least 500 pieces out of it. So the puzzle is not complete at all. Okay, guys, any other question? If not, I think we will meet again in 1 hour time, right?
Not sorry. The tutorial is at 2:30 time, so.
Sorry?
The tutorial will be at 2:30, so more than 1 hour.
Okay. How many more hours? Sorry, 3. Right. It is at 6:30 Italian time. Yeah, I checked yesterday the time lag, so it is at 6:30 at Italian time. Okay, so I mean, I suggest this. So we will meet in 3 hour time. At 6, if I'm allowed. So if I'm allowed, I would suggest you to grab a beer, to grab a glass of wine, so have a friendly discussion in the tutorial time. I don't know, Gabriel, we are allowed to do that or not?
Yes, totally. I am not sure that I could join you because I will have another meeting after that. So
okay.
They will realize that I'm a bit more brilliant than usual. So.
Okay. But since that we are in our own rooms, I think that we can't be of any danger for, let's say, the institution. So I will grab my beer at 6 o'clock, and we can still talk about the. And I will promise to be as efficient as possible. Anyway, so we will go through the data included in the remaining part of the presentation. I will hand you the slides. So right now I will send them to Gabriele and Andrea. We will meet again in this platform, isn't it? The link is the same, right?
The same.
Okay.
Perfect. And the students may take the time that they have free now to read the slides that you are sending, so that the conversation will be more productive.
Okay. No, I'm laughing because I see Angela's face. Angela, we met already at the Master in Cooperation Development in Pavia, and I know that I already bothered them with these slides, more or less. So probably Angela already tried to kill herself after that presentation, but she survived. So I don't know if it was my fault or not, but anyway, it doesn't matter.
She may replace the beer by vodka if it's too much. Something stronger.
Exactly. Okay, that's fine. So see you in 3 hours time, right?
Okay.
Thank you, everyone.
Thank you very much, Alberto. See you later.
Thank you. Bye.
Thank you.
Bye. See you later.
Bye.
Bye-bye.